The Fed is expected to make a decision on interest rates next week, and a lot of people are confused. They don't really know if they're actually going to continue raising rates, at least in the next meeting, as a result of the bank failures that we saw over the past week. And so that's what I want to dive into a little bit. And so, guys, as you smash that like button, let me run that intro. What's up, guys, and welcome back to the channel. Now, just before the bank failures that we saw over the past couple of weeks, we started getting really strong economic data, which suggested that interest rate increases were going to speed up. In other words, the 25 basis point increases would turn into 50 basis point increases, at least for the next raise. However, in light of what's been happening now with the banking crises, it's up in the air essentially as to which direction these rate increases are going to go. And I actually want you guys to opine in the comments to let me know what you think the Fed is going to do, but I'm going to point to some interesting data in this video. So as you guys may recall, some of you guys might have actually missed this, but the jobs report did come out last week, and it showed that the unemployment rate was 3.6%, which is actually one of the lowest unemployment rates that we've had in a long time, I think since going back into the 50s. And it looks like, the payroll gain amounts are starting to cool from last year. So we're heading in the right direction. So this would suggest that things are starting to move in the direction that the Fed would want it to go. And I just wanted to show you guys how quickly the unemployment rate actually dropped. So notice that in February of 2021, we were at 6.2%, and now we're at 3.6%. Now, the headlines are saying, unemployment rate is going higher, but has it really gone that much higher? Like, the lowest we've gone is 3.4% in January like last month, or I guess January of this year. And so, the fact that we're going to, or we went from 3.4% to 3.6%, I would call this pretty much the same thing. So, I wouldn't pay attention to the headlines that are saying that the unemployment rate is starting to increase. Yeah, it has increased, but it's been going up and down. See 3.5, 3.7, 3.5, 3.7, 3.6. Like, it's just up and down as of March of 2022. So I wouldn't put too much stock in the headlines, where I think really it's just more for clicks than anything else. And I think the real question is, and this is something that I have brought up on the channel before, the real question is, why is the unemployment rate so low? Like 3.5, 3.6 is a really good number. It represents a strong economy. And essentially what's happening is the unemployment rate, you guys might recall, only measures the percentage of people who don't have a job, who are looking for a job essentially, or who are able to work. The participation rate is the number of people in the population who are actually working. And so notice that the participation rate declined from, the 63, I'll call it 63.25%, which is kind of like where it was, but it was kind of around 63%. And notice that it actually never came back. But, if you go far back enough, around 2016 or so, we're kind of at those rates right now. So, and the interesting thing is that it is starting to push back upwards. And so, can we get back to the 63% range? I think we could, but in the face of further rate increases, I don't know if we get to that point. But I think a couple of things are happening. I think one, the higher wages are pulling people into the job market, but two, I think higher costs of living are pushing people into the job market as well. And so that's why you're probably seeing this surge. And I hope that there's more economic data to support that, but that's kind of like what I'm thinking from a high level as to what's happening. I think the Fed is right that a lot of people decided to just retire early. A lot of older people got displaced, and a lot of people focused on caring for family and such. And so a lot of people just sort of like changed the way that they wanted to live. And maybe a two-income household doesn't necessarily make sense to them anymore, especially in a work-from-home environment where you can move somewhere that's a little bit cheaper than one of the more expensive states or cities to live in. And so, I think a lot of people made decisions that have kept certain people out of the job force, and I think that might continue into the future. But once again, economics might push people back into the workforce. So we'll see how this plays out, but I don't know if it's going to move materially from here. I think it could go back to 63 but we'll see how that plays out. And so you would expect that the non-farm payrolls job growth would actually run higher than the pre-pandemic average, because you can see that that participation rate has been going up post-pandemic. So obviously we're just getting back to the number of people that were employed prior to the pandemic. So that's all that's really happening there. So you expect this to run higher than the average. But notice that the industries that are adding the most are leisure, hospitality, retail, healthcare. And the industries that are cutting are transportation, warehousing, finance, manufacturing, and tech. And so it's very interesting how the industries that did very well during the pandemic are now cutting. And I don't think that's much of a surprise to many people. And here's that point illustrated more. And so you can see that in 2021, early 2022, when things really opened up, you can see that leisure and hospitality, the CPI, so the wage rate growth went up exponentially, to close to 15%, but of course it's started to come down. So this is what the headlines are starting to say, as wage growth starts to come down, it should bring everything down. But notice that nothing has really been running significantly under CPI. So the wage growth amount as a whole is around 5%. At least that's what it looks like here. I might be misinterpreting this chart, but nothing's really running under the CPI rate. And so, I think in order to bring the rate of inflation down, you're going to have the wage growth run under it. And it's just not happening right now. So we'll see if, further rate increases get this to happen. And I just wanted to show that unemployment rate in a historical context. So notice that the 53-year low is 3.4%, which we got to just a couple of months ago. So we have not had an unemployment rate that low since the 70s. So earlier in this video, I said 50s. It's actually the 70s. And so, politicians will hold on to this and say, hey, I have the lowest unemployment rate, blah, blah, blah. But the real point of the story is that there's not as many people participating in the economy. And, if you keep pushing rates up, something could potentially break. Like we just had a couple of bank failures, right? Other things can break. There could be reverberating impacts that could really push the unemployment rate higher. And so as a politician, I don't think it's a good idea to hang your hat on the unemployment rate. And this is the reason why the wage rates have surged so much. Notice that the number of job openings are significantly outpacing the number of people available to work. And so obviously that's pushing up the price of or the cost of the labor, because you need to raise your wage rates to attract people. And so this is having an effect, and it's continuing to have an effect throughout the economy. This is not new, right? Like we all saw this in mid 2021, and it's continuing into 2023. And notice it dipped a little bit, but we'll see if it remains at this level. I think you keep increasing interest rates and this will continue to dip. And so let's see how that actually plays out. But once again, it's still a very large gap at the moment, which is not good for bringing down the CPI, I think. And so this brings me to the question that I had earlier in the video. What will the Fed do as it relates to increasing rates? And this article actually came out before the bank collapses, and they did mention that the February reports on hiring will guide the rate decision making. However, we've since seen the bank collapses, and so I don't know if you're going to see a 50 basis point increase. This is what I wrote before the collapse. I said, based on the jobs report and what Powell stated, it's almost certain that rates are heading higher. And what I was really getting at there was it's almost certain that rates are heading higher by 50 basis points, but I don't think that's happening anymore. And so this is what I mean. This article came out on Monday, and they're effectively saying that the markets do expect the Fed to keep up its inflation fighting efforts, and they do expect a 25 basis point increase to the interest rate. So, the majority of the market did expect a 50 basis point increase prior to the bank collapses. And so now the majority of the market is expecting a 25 percentage basis point increase. However, notice that Goldman actually came out and they said they might actually pass on increasing rates this time around. And so we'll see what the Federal Open Market Committee does. I'm kind of siding with Goldman. I don't think they raise rates this time around, but actually, you know what, the more I think about it, the more I think, you know, they probably will get to that 25 percentage point increase. But I think it's probably a good idea to do nothing this time around and provide a little bit more confidence into the banking industry and into the economy as a whole. And so we'll see how it plays out. Now, keep in mind that there already is a ton of confidence. Like, the market is already starting to go up, and in fact the market didn't collapse as much as you would expect it to collapse with a banking crisis. But you know, they also did add a lot to the federal balance sheet as well, the Fed's balance sheet, just by bailing this stuff out. And so, you know, they don't want to call it a bailout, but that's effectively what happened, at least in my opinion. And so, you know, I don't know if now's the time to tighten up. I would say wait until the next meeting, but you know, it's up to them. We'll see how they do it. Now, I do want to show you what they were thinking before the banking crisis happened. I have shown this on a previous video, but you know, as of the last monetary policy report, only one member in the Federal Open Market Committee believes that rates will go as high as 5.75. But my question is, you know, will that change now that not just the job report, but will that change now as a result of the banking failures? Like, how much additional stress do you put onto banks now that you're noticing that some of them did not properly calculate the duration of their deposits relative to the duration of their investments? And so how much additional pressure is there in the banking system? I think the larger banks are fine, but these smaller banks, they could be under additional pressure. And so, you know, do rate increases actually stop, you know, closer to that 5%, maybe under that? You know, who knows how this plays out. But I just don't think you're going to go as high as 5.75, which is that one member was saying. And in fact, I originally thought that you were going to go higher, but now with the bank failures, I think you're probably going to end up somewhere around where these people are sitting. And so I want to know what you guys think. Let me know in the comments below. Now, guys, I recently put out a video explaining the whole banking crisis and kind of like my thoughts on the whole situation. So if you've missed that video, no problem. You can get to it right here.